Welcome back to EDS, and in this video I'm going to show you how you can dominate the options market in 2025. 2025 is just around the corner. At the time of this recording is the 19th of December 2024. So I'm going to show you how to kill it in 2025. So first thing you want to do is just pull up any equities underlying. We've got Palantir open at the moment. We've got a position on Palantir which is behaving absolutely perfectly. This is a beautiful trade so far. But the first thing you want to do is navigate to any any equities underlying, and then you want to move over to where you can see a list of expirations for that underlying. Now, all equities have the same expiration dates. They all operate on the same expiration cycle or option cycle. So this is why it doesn't matter which one you pick. The purpose is just to lock in on an expiration date at this point. So we want to pick an expiration date that's between 30 and 60 days out in time. It also needs to be a monthly expiration date, not a weekly or quarterly. So right now, as you can see, there aren't any expiration dates that actually fit this criteria. The closest ones we have is January 17th with 29 days left on the contract. And then the next one out is February 21st, which has 64 days left on the contract. Now, at this point, you can simply just wait a couple of days, or you could pick either one. It doesn't matter what you do here at this point. It doesn't make too much difference. Neither option is wrong. You can wait. You can go with January 17th. You go with February 21st. It's personal preference at this point. I'm just going to go with January 17th, which is 29 days out in time, so we can get a bit more of the aggressive side of theta. So January 17th, 29 days. So we can take that information, come over to our watch list, and we can simply filter out any and all underlyings that have earnings over the next 29 days. Now, the reason for this is because an earnings event will increase volatility up to the earnings event, up to the earnings announcement, and then volatility will come out of the market after the announcement has been made. We want to avoid the build-up of volatility at the on the front end of the earnings announcement. We can make volatility plays, but we typically want to do that, the day before, the night before, something like that, before the actual earnings announcement. But that's a completely separate play, and it's completely separate. But for our bread and butter on our portfolio, we want to just stay away from earnings as a general rule of thumb. We also want to remove any underlyings that have a low liquidity rating level. We only want to trade liquid markets with tight spreads. The spread is the difference between the bid and ask, and is what you pay every time you get in and out of a position. So the tighter the spread, the less we pay and the more profit we keep. So that's why we want to do that. This is a pre-made watch list. You can use any watch list you like. The platform that I'm using, most brokerage platforms will have pre-made watch lists. It doesn't really matter. I personally like to order my watch list from high to low IVR. The reason for this is because volatility is mean reverting, and the higher the volatility, the higher the options premium. We are writing the contracts, or another way of saying it is we are selling the contracts. So that essentially means that we are short the contract up front, and then we want to buy back at a lower price. So we sell high, buy low. That's how we make money. And by that logic, it makes sense to sell when volatility is high and then play the contraction back down to the mean. And as volatility comes out of that underlying, our P&L will be green, or it should greatly assist to our P&L being green. Of course, there are other factors as well that influence our P&L, not just volatility. And IVR is a great metric that we can use to determine where implied volatility is relative to itself for that specific underlying over the past year. So generally speaking, anything with an IV rank of over 50 is considered high. However, over 30 can also be considered high. Now, yesterday was the FOMC meeting, and the market tanked, and volatility is very high today. So we are spoilt for choice in terms of what we can trade, and we just want to go down the list and see what would fit well inside of our portfolio. Keep things nice and diverse, use common sense, and you'll be fine. Stick to nice and broad sectors. Try and trade ETFs as much as you can. So we're just going to go down the list. UAL is looking very nice with an IV rank of 102.8, but we've had a look at UAL quite a few times recently. IV has been quite high for UAL. Vale trading at just under $9. Now, $9 is a bit too cheap. The only time that we would look to trade smaller underlyings like Vale is if we are simply going to look to put on a cash secured put, or just sell a put, or just sell one side of the market, or something like that. Generally speaking, we want to stick to things that are over $40, $50. It's much easier to find the right strikes that we want in those kind of sizes of the underlyings and above. So CVS here with trading at just under $45, an IV rank of 87, and an absolute IV level of 49.5%, or implied volatility level. So if we just have a look at CVS, we already know we're going to be at January 17th. And this is now the options chain that we're looking at here. So this orange horizontal line shows us where price of CVS currently is with respect to the strikes. These are the strikes down the middle, and this vertical orange bar shows us where the expected move of CVS is over the next 29 days. So the market is expecting CVS to move within this orange bar here. So we can use this information as well as other things to craft our trade. Now, one thing with options is we can set our own terms on entry, which is a very, very powerful thing. And I'm going to show you how to do that. So we want to have a high probability of success. Anything with a more than 50% probability of success is considered high. But we want to be, anywhere between 60 and 90%. It's much easier to have 9 winners and 1 loser, and then manage that 1 loser and try and work it back to a scratch or a break even, than it being the other way around, whereby you have 9 losers and 1 winner. So we want to minimize losers as much as possible before we even put the position on. So we want to be outside of the expected move. And we've also got these dotted blue lines, which shows us the standard deviation levels. Now, the first dotted lines closest to where price currently is our first standard deviation mark, and then second standard deviation mark further out, so on and so forth. So if anybody knows how standard deviations work, anything within a 1 standard deviation range has about a 68% chance, or 68% likelihood. That's what standard deviation means. So anything within these first blue lines here, basically what this means is price has a 68% chance of staying within these blue lines here. That's a very, very powerful piece of information that we can use to create our position. We also want to use delta, and we want to stick to a delta between 15 and 20 deltas. In this case, we're probably going to have to be a bit more aggressive, but that's okay. And this is why we want to use all 3 bits of information: the expected move, standard deviations, and deltas. So as you can see here, there's a 15 delta and then a 24 delta. There is no 20 delta. And this is where the strike selection comes in. So CVS is a bit on the small side. If this was, say, $35 or $25, we probably would struggle to even get a position on. But because we're between $40 and $50, it's kind of okay. It's a little bit acceptable. So the 24 delta is where we're going to be at, because that lines up nicely with the 1 standard deviation level, and it's still outside of our expected move, as you can see here. So this is going to be our first contract that we write, our short call. And then on the put side, we're going to do the same thing. And on the put side, we've got a 10 delta, an 18 delta, and a 31 delta. The 31 delta is probably a little bit too aggressive for us in this instance, so we're going to go with the 18 delta, which lines up nicely again with the 1 standard deviation level, and also we are outside of the expected move. So this is the trade setup right now, and this green bar here shows us our break-even zone. So as long as price is within this green bar at expiration, we're going to make money. So how much money are we going to make? And what have we actually done here? So what we've done is we've created a range for ourselves, and as long as price stays within this range by expiration, we keep all of the premium that we collect up front. So price can move up, it can move down, it can move sideways. As long as it doesn't move higher than 50 or below or lower than 40, we're going to make money. So we've got a 69% probability of profit here. And what that means is we've got a 69% chance of making at least 1 penny on this position. And we know this information before we even submit the order and get filled, which is very, very powerful. And if you want to get out of this position at 50% of max profit and not hold all the way to expiration, then we've got about an 80% chance of that happening. So we're looking at between a 69 and 80% chance of success here. Very, very high probabilities of success. Now, what is our actual profit and risk here? So the amount of premium that we collect is $1.47. There's 100. Each contract controls 100 shares of the underlying, so you'd multiply this number out by 100, which gives us our max profit of $146. So this is premium, and this is what we collect up front. As soon as the order gets filled, this gets added to our cash balance. $146. So in the instance where we are looking to get out of 50% of max profit, it would be 50% of $146. That's what those numbers mean. Now we have an unlimited loss potential because these positions are naked. There is nothing covering these positions. These are just short, naked positions. But as long as you manage risk correctly and know how to make adjustments, etc., you won't ever need to take an unlimited loss. The broker just has to display that, because technically, yes, it is an unlimited loss potential, but we wouldn't actually take an unlimited loss. So we'd collect $146 up front, and the broker is going to require $450, a little over $450 in buying power to open this position. So as you can probably work out, this is a very high return on capital, especially for a naked position with such high probabilities of success. Now, I think $450 should be able to fit inside most people's portfolios. It's a very small position. However, the unlimited max loss potential may put some people off, and that's completely fine. So what I'm going to do is I'm going to show you how to turn this into a defined risk position, so we no longer have an unlimited loss potential. So what we can do is simply buy a contract to cover our short contract a little bit further out, say $5 wide at the 55 strike on the call side. On the put side, we can do the same thing at the 35 strike. So now what we've done is created, this is called buying the wings, right? And essentially we are covering our short contracts. And if you notice here, we now have a defined max loss. It is no longer unlimited. How do we arrive at this number? Well, our max loss, or our max risk, I guess you could call it, same thing, is the spread in between our short and long contract, which is $5, minus the premium that we collect up front, times by obviously the contract multiplier of 100, and that's how we end up at this max loss here. Now our broker knows what our max loss is, and so it's only now going to require as much as whatever the max loss is in buying power to open this position. It no longer needs to hold more funds to cover you in the worst case of scenarios, or in the worst 5% of cases, which is what CVAR is. So in doing this, we now have a defined risk position. We no longer have an unlimited loss potential, because our return on capital was so high on the naked position. It almost doesn't make sense to have a defined risk position, as long as you're comfortable with having an unlimited loss potential. However, if you wanted to be more capital efficient, what you could do is, or not capital efficient, sorry, if you wanted to use less capital, you could simply just make your spread smaller. So instead of it being $5, make it $2.50, and you can just do that on both sides. And now the amount of buying power that is required to open this position has been reduced even further. Now, if you notice, the premium that we're collecting is less and less, because it costs money to buy these wings. So we're using that. So on a purely naked position like this, we collect $1.47. Now, if we wanted to buy this contract here, at the 52.5 strike, we're going to be paying 46 cents. So as you can see, it's now our overall premium has been reduced. And if we want to buy it on the put side as well, as we can see here, it's going to cost 34 cents. And this is why our premium drops. And because our premium drops, It means that our break-even points are getting smaller, as you can see here with this green bar. That's what that's showing. And in turn, our probabilities of success suffer slightly, but generally speaking, we will have a higher return on capital to offset that. Now, like I mentioned, in this instance, I would opt in for the naked position as opposed to a defined risk position because the overall return on capital is so high to begin with, and because obviously it requires such a small amount of buying power in the first place. Now, if you want to know how much buying power you should be allocating to your positions, we've created a position sizing template that's free for everyone to use. The link is in the description. And the way it works is you enter in the size of your portfolio here, and then you enter in what the current VIX level is. And then everything will then be automatically calculated for you. And all you need to do at this point is simply use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to a single defined risk position, undefined risk position, and how much of your portfolio you should be allocating to short premium strategies in general. So as long as you follow this, you'll be absolutely fine over the long term. And if you want to learn in more detail about what we do and how we do it, again, link in the description. This time, click on EDS Premium. Get yourself signed up. Inside, you will have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, the adjustments that we're making, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. This allows you to learn the theory and then see how it's applied in real time. And you can use those positions as inspiration, or you can just simply copy them. It's up to you. It is a private community, so if you get stuck at any point, you can speak with myself directly or with other like-minded individuals. There's a 100% money-back guarantee, so once you have studied our full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part. Right now, it is £1 a month. It's so cheap because we've just launched. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And the goal here of EDS Premium is to get you completely self-sufficient within 6 to 12 months to a point where you know how to write options contracts and collect premium day by day, week by week, month by month for the rest of your life without any external help or influence. Of course, you are always welcome to stay and be a part of the community, but within 6 to 12 months, you should be able to do this, and you should have learned the skill, and no one can take it away from you. You should be able to do this for the rest of your life without any external help. So with that being said, I will see you guys on the inside.